This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Moving on. Adjusting the accounting profit. Now, tax adjusted trade profits for inclusion in the income tax computation are not the same as the profits shown on the individual statement's profit and loss. Let me show you what I mean. So when you do a set of accounts according to accountancy laws, you have sales, then you take off cost of goods sold, that then gives you gross profit. You'll learn this from your other modules. We may then have additional income, which isn't trading. So that could be rent, it could be bank interest, it could be dividends. Now, all of those are taxable, but not here, because we're looking here at trade profits. So we would then deduct from those two forms of income expenses, which would then give us our net profit. Ooh, can't spell today. Net profit. So the purpose of this chapter is to work out what the profit is that relates only to the trade. And therefore, we need to adjust this figure, and we add back expenses that are not allowable for tax purposes, and we're going to go through a big list of those. And then we deduct these additional forms of income because they go elsewhere in the income tax computation in those various columns. So rental income is non-savings income. Bank interest goes into the savings income column. Dividends, shares, that goes into the shares column. And you, if you go through chapter 2, you will see the various different rules that work with those different forms of income. So this is our starting point. Just wanted to explain to you kind of why we have these rules. Okay, so accounting profits before tax are adjusted to arrive at the tax adjusted trade profits. Okay, so accounting profits is where we start. That's your net profit. And then we need tax adjusted trade profits. And you notice here that's our starting point, as I explained. Copy that from the question. Now, very often in these questions, you're given very succinct, to the point instructions as to how to deal with this. So when we do the big question in a minute, you will see how that works. We will then this is your pro forma. This is the pro forma you need to be aware of. The one now, this pro forma is the same for individuals, partners, and limited companies. So it will come up in the exam, and it will probably come up as a section C question, either for an individual, a partner, or for a limited company, or it'll come up in a losses question. But this will come up in an exam. So make sure that you learn how the pro forma works and go through it time and time again and practice it. You start with net profit per the accounts, which will be given to you in the question. Then you add back expenditure which is not allowed for tax purposes, and there's a list of those we're going to go through next. Then you deduct or take out items not assessed as trading profit, so items that are assessable elsewhere, such as property income, interest, or dividends, which is what we looked at earlier and explained, or any exempt income. That then gives you what's known as adjusted profits, we then take off capital allowances, which is the next chapter, which gives us our tax adjusted trade profits. Now, when you prepare this calculation, be careful to start with the net profit from the accounts, and I cannot emphasize this enough, read the question very carefully. So let's have a look at what expenses we have that we need to deal with. Now, wholly and exclusively, we looked at that in our property chapter. Wholly means totally, and exclusively means what it is. It's exclusively only for the purpose of the trade. Now, there is a long list of these. Some of them you'll come across regularly, such as depreciation. Some of them you will only come across very irregularly. I'm afraid you've got to learn what they are. So let's have a look. Depreciation is not allowed. Now, why is depreciation not allowed? It is an expense. Okay, you buy an asset, it does depreciate in value. However, depreciation is very much an individual's perspective, and you basically lick your finger, stick it in the air, see which way the wind's blowing. How much depreciation do we want to apply to our assets that we own in our business? Revenue don't like that. So you have to add back any depreciation expense. They do give you an alternative, and that's the capital allowances. So they do recognise that depreciation is an expense, but capital allowances is full of rules and regulations that the revenue can control, and therefore they prefer that. So again, we recognise this from the property income discussions that we had. Repairs are allowable. Improvements, capital items, are not allowable because they are taxed under capital gains tax. Loan interest payments for capital items, again, not allowable. Irrecoverable debts, if they are trade debts, they're allowable. If the words are non-trade debts, they're not allowable because they are not exclusively for the business. I think you're getting the idea now. So that would need to be added back. Entertaining. Entertaining is disallowed unless it's entertaining employees. That is allowed. Gifts to employees are allowed. Now, gifts to customers. These are the rules. They are allowable if they are less than £50 per person per year. But then, if it is food, drink, tobacco or vouchers, it doesn't matter how much they cost. Okay, it could be £30 worth of food. Doesn't matter. It's food or it's drink or it's tobacco. Therefore, it's not allowable, regardless of how much. And the gifts that you are allowed must have an advert on them. Okay, pencils, stationery, that sort of thing. Subscriptions and donations. Trade subscriptions, again, we're looking at trade, wholly exclusively, allowed. Charitable donations. Now, if they are small and for trade purposes, and they are local, small and local, they're acceptable. However, if it's a national charity, not. Okay, and neither is anything made under the gift aid payment, which is in the income tax chapter, or political donations. They're not allowed for tax purposes. So you're looking for small and local. As I've said before, if you are unsure whether something is small and local, or it's a charity, normally the question is fairly obvious, and sometimes they'll actually give you two, a national one and a small and local one, because they want you to be able to differentiate between the two and add back the only one, not both of them. If you're unsure, make a decision right at the bottom. I have decided that this is small and local. Shows you understand that there's a rule. Whether you've applied it right or not, it gives the examiner a thinking into the way you've answered your question. Legal and professionals are allowed as long as they are trade and not related to capital items. These are specifically allowed: the cost of obtaining loan finance and the renewal of a short lease. Interest paid on borrowings, if it's trade, it's okay. Just leave it where it is. Now, rental cars. There's a specific rule for this. Anything over 50 grams, 15% of the leasing charge per annum needs to be added back in that computation because it's a disallowed amount. Premiums on leased. We've looked at this in the property chapter. It will make sense in the property chapter. The premium itself is disallowed and the amount that is computed. So we looked at one where we had a landlord, gives a tenant a lease, and we're looking at the tenant's perspective here. Now, the landlord is giving them, say, a 20-year lease, and they're paying £20,000. If you remember from the property chapter, the landlord doesn't pay tax or include that figure. You have to do the calculation in order to be able to work out what that amount is. And then the tenant uses the same figure but spreads it over the number of years of the lease. The property chapter goes into a lot of detail on this. You should have seen the property chapter before you've done this chapter. If not, you can either stop at this point and go back and watch it, or make sure you watch it before you go any further, before you do any big questions. Fines. You've done something wrong. If you've been fined or you've been penalised, you've broken the law. So they are normally disallowed, especially if it's the owners. Now, some employers will pay their employees parking fines. It will say so in the question. Private use. Quite often in a small sole trader business, there will be a crossover between an expense that's a business and an expense that's private. So, for example, the owner has a shop and lives in the flat upstairs, and the insurance for the building comes as one figure. Now, the question will divide that figure and tell you whether it's 50-50, 40-60, and basically you do the maths. And you only allow the business element to stay in the trading profits, and you have to add back the private element, and it will tell you. It links with all sorts of things. Make sure that if they put in the question private expenditure, it is for the business owner and not for individual employees. Don't be confused. Sometimes they do that and put it in, and students make adjustments, and there's no need to, because the individuals who work for the business, that's an allowable expense. Any salary that the owner withdraws is not salary it's drawing, needs to be added back. Interest on overdue tax. You didn't pay your tax on time, so you've been charged, you've done something wrong. You can't have that. You need to add it back. Salary paid to a family member. So, for example, we have a lady that works in the office, and she works from Monday all day, Tuesday and Wednesday morning. We pay her £5,000 a year. Then the owner's wife works Wednesday afternoons, Thursdays, Fridays. She does the other half of the week, but we pay her £15,000. Why? Because she's the wife. Now, that excess salary needs to be added back. Not all of it, just the excess. So if the receptionist is paid 5 and the wife is paid 15, then the 10 is what you would then add back. Goods for own use. If you're taking goods out of the business for your own use, you have to pay for them. That then has to be added back into the profit. And also if you had any pre-trading expenditure, 7 years before you can have pre-trading. As long as it's an allowable expense, you can claim it once the business is up and running. So let's look at an example to put all these rules into place.